Hi everyone, this is Paul Lange from Disciplined Trading Strategies with another topic on a series of educational topics that you can find at Disciplined Trading Strategies on the Free Stuff page. This is a timeless topic, but it probably is appropriate as I'm recording it now at the beginning of 2025 because of the bull market run that we've had and people get spoiled and complacent. So I want to talk about living through a pullback. Naturally, I understand, and I've discussed, there are some people that maybe started dollar cost averaging in since they were 20 and they will never sell anything till they retire. That's great. I'm all for you. Unfortunately, 94, 93% of the people out there are not in that situation, and they are a little more active either on a midterm basis, a long-term basis, or a swing trading basis, and that opens the door to making mistakes. So I want to review something with you that is just of the utmost importance to always keep in mind. First of all, I'd like to show you a difference between two different traders and how they handle a potential pullback. And this is actually at the very essence of how I do my long-term trading and how the DTS long-term traders actually run and why it is so successful even in bear markets. Let's say we get to some point where the market is just extended and we don't have to find the top to the market. We just simply have to say, hey, we are way, way up there and my positions are really doing well. Well, what the average trader may do, which actually the vast majority of traders do that are unskilled in the market, is to just hang on. So we start a pullback here, we're down 10%, we're down 20%, things aren't looking good, call that a bear market. Now we're down 35%. Wow, this really hurts. Whew, coming back a little bit, only down 20%, only down 5%. Thank you to the trading gods, not too bad. Now, naturally, a lot of things could happen along the way, but I want to compare that to another way to end up down 5% and think about which way is better, which way you would rather handle it. Trader B, off the top here, decides to sell some longs and to add some short positions, 80 long, 20 short, down 5% instead of down 10% because they adjusted some of their portfolio. 25% long, 75% short. Now they kind of flip hard and go hard short, and they're actually up 10% now when our trader A was down 20%. When trader A is at his worst, down 35, we're actually up 15% because we have to now kind of unwind as we maybe hit a bottom, 50% long, 50% short, up 5%, boom, end up down 5%. The point is two identical end up scenarios here at down 5%, but which one would you rather be? Now you could say this is easier, lazier, you just sit there and do nothing and you end up the same. However, how do you know that it ends here? How do you know down 35% is all you're going to be, or down 20, or wherever you hit bottom? And is there any plan at all to preserve any of your profits? Because the bear markets that come are very nasty. It took 17 years for the market to recover, the NASDAQ market to recover from the 2001 drop. Do you have that much time? The advantage here is that if the market were to keep dropping, we're actually making money at this point. And even if you botch it up a little bit, the point is that you don't care about the bottom necessarily because you're profiting at least to some degree from it, depending on how well you do. Now, this requires a little skill. I'm not saying it's easy to do. However, it doesn't require that rocket science approach. I believe in trading using shotguns rather than BB guns. That's an approach maybe you understand. But it opens the door to the question of just how do you handle that if you do keep falling. If you're trader A and you're just hanging on, well, that's great. If you're in your 20s, maybe that's the way to do it. You're not listening to me and you don't care about any of this because you're just buying stuff and you put it away and never look at it. But if you're listening to me, you're not in that position. You're a little more active. And the problem with being active is what happens when you put some money in and all of a sudden it's going negative. Here's a problem that happens when you're in this down 35% situation. If you didn't sell yet, or if you didn't take any action to protect yourself, when are you going to? Maybe you will never sell, maybe you can't, but if not, if you do plan on managing this, what is your plan? Maybe you don't have a plan, so you just don't know how to, or maybe you have a plan, a stop in place, but you just didn't honor it. Why wouldn't you honor a stop? Maybe you're saying when I'm down 10% in each of these stocks or the whole portfolio, I'll sell it or whatever it is, but why would you not honor that? Well, if you've been around for a while, you probably have not honored that in the past at some point. There's a lot of reasons traders don't. Number one reason, you're thinking it will come back, right? We're trained to think that way because we're always in bull markets. Well, we're not always in bull markets, but we are the vast majority of the time, both time-wise and price-wise. But when bear markets come, they're nasty. And if you listen to the news, they will only make the situation worse because to them, everything is a pullback because they can never ever say a bear market's coming. It's against their plan because they have to maintain their audience. Nobody wants to hear a bear market's coming. So it'll always come back. That's what you're hoping for all the time. And unfortunately, you've probably been trained the wrong way that it has come back for you in the past. So you think it's always going to come back. Number two, I'm down so much money now, it's too much money to lose. I got to hang on. That's the next thought process. Think of how silly that actually is. I'm buying a pullback. To a trader who's trying to justify their losses, they're always saying, I'm buying a pullback. I'm adding to it. I'm not adding to these positions, but I'm adding more long positions. Well, it's the same thing. You're adding to your pain. Not a good way to handle it. Just needs a little more room. Everybody's afraid that the second they sell, that's going to be the bottom. It's going to turn around and go higher, and then they won't be in the next rally. I should have sold earlier, but I just can't sell now. Maybe you've been in this position on small pullbacks, maybe on a particular stock you've been in that position because you got hurt. Maybe you were around for the crash of 2008 or the crash of 2001, and you know exactly what I mean by this. And I want you to look at what I wrote here and have circled. That is so very, very important. That all of these reasons up above, which are not good reasons, all of these reasons here, not real reasons, you justify them in your mind, and for whatever reason, as wrong as they are, whatever you're thinking, remember that every time you drop more and you're more in pain, every one of these reasons becomes even stronger. Now it has to come back. Now I'm down way too much money to lose. Oh, this is certainly a nice pullback. Oh, it needs just a little bit more room. And oh, I just can't sell it now. Every penny that drops, it becomes exponentially more difficult to take your stop. So I want you to remember that as we go forward. That's how people get into trouble. Do people get into trouble? Here's a stat for you to remember. In 2003, after the 2001 crash, we're still coming off the bottom, 97% of the E-Trade accounts were dormant. That means broke. E-Trade was the #1 broker at the time. In the late 90s, it was the home for the new online investor, the online trader, the online day trader. People got wiped out because they didn't understand that bear markets come. Is a bear market coming? What do you think? Are we going to have a bear market? What are the odds that the market will crash? Do you know the answer to that question? I can give you the answer. The odds are 100%. No question about it, absolutely mathematical certainty. The market is, in essence, a Ponzi scheme. Don't get me wrong, I love the market. You just have to understand that it is a mathematical necessity that the market will crash from time to time, and some of them are very nasty. This next one is going to be a very nasty one. Exactly when it's coming is always the question. Most people are always way too soon in predicting bear markets. Many people lose a lot of money predicting the bear market's coming when they don't know what they're doing. So you got to be careful. But when it comes, you have to be prepared for it. I just want to give you a few comments about living through a pullback, the goods and the bads, so you can be aware and maybe a little more prepared for the next time we enter a difficult situation. If you like comments like this, be sure to join us for the next Introduction to Mastering Technical Analysis course. It's presented live. Check the website and the DTS calendar for the next date coming up. I'll see you then. Until next time, this is Paul. Good trading, everybody.